Folks, there's been a real big shift in flows, right, into risky assets rather than safe assets. It's seen right here. You can see, of course, this is where we were when everyone was panicking a couple of years ago. This has come on really strong. So to Ali's point, people feel very, very comfortable piling into risky assets. And my next guest says that stocks are due for more upside. I want to bring in Kobeissi Letter editor-in-chief, Adam Kobeissi. So, Adam, I'll ask you what I was getting at with Ali. Is there too much euphoria out there?
Charles, I've been saying on your show basically all year that regardless of what happens in this market, we think it's going higher, and I think that still is the case. It's partly because of what you just mentioned. Risk appetite right now is arguably at its all-time highs. I mean, just about anything that happens in the market is being perceived as a positive event. And we've priced out 4 to 5 rate cuts this year. We're at all-time highs now. We actually had a 5,300 target on the S&P 500. Today, we raised that target to 5,400. And I think right now it's just there's so much momentum. It's a bad market to step in front of. And the reality is many people are learning that the stock market is not the economy and the economy is not the stock market. So you can have bad data with higher equity prices and vice versa. And that's just the way it goes. At the end of the day, the market is always right.
But that's only 100 points away from here, Adam. I mean, just how convinced are you?
Yeah, well, we initially went long months ago, and we've kind of just been gradually raising our target. And I think our strategy here is just keep riding the wave until the trend breaks. If you're making higher highs and higher lows, there's no point in fighting that. It'll be pretty easy to determine when that trend breaks as soon as we see lower lows and lower highs. Yeah, you might lose out in the first few percentage points, but it's a lot more cost-effective and a lot more profitable in the long run than trying to just time the exact high in the market. That's been our strategy all year.
I've got the S&P 500 heat map up here. Obviously, much more green than red. Some things stand out. Netflix and Disney, particularly Disney. Amazon and Tesla, they're also down. I want to ask you about this, the technology area, because that's driven this whole thing. There have been pockets of weakness. I mean, is tech as invincible as it was at one point before?
We've definitely seen more volatility, but look at NVIDIA today, pushing it's a few percentage points away from a new all-time high. A lot of these tech names that you've mentioned are up pretty sharply, especially after the recent earnings season. And I think the market had a textbook opportunity in April to have a long correction that everyone's been calling for. Tech stocks actually fell, many of them 20% from their high. But now we're right back towards that all-time high territory, a lot of them in all-time highs. It's proven that even in the wake of these large swings, dip buyers are stepping in. I don't think tech is looking any weaker now. And we talk about AI a lot. 1/3 of all S&P 500 companies are now talking about AI in their earnings calls. That's been on a steady increase over the last year to 2 years.
Yeah.
I think right now the market is getting the narrative it wants, and even though we believe we're only going to see 1 to 2 rate cuts this year, I think you can see higher equity prices even without a Fed pivot that everyone's looking for.
That's amazing, right? We started the rally in October last year with 7 rate cuts. We got down to maybe 1 rate cut. It doesn't matter. Rate cuts, no rate cuts. We go up from here. You still see more upside in the S&P 500. You talked about that. How much more in bonds and gold?
So we actually turned bullish of bonds and gold after being pretty bearish for the majority of the start of this year in mid-April. And our thesis really was here that the pendulum had swung so far in the direction. We actually had no rate cuts priced in at one point for like a couple-day period. Mm-hmm. And that pendulum has swung from extreme dovishness to extreme hawkishness. We thought it needs to swing back to the middle. Right now, it's getting more towards the middle. Which is why we started buying bonds and gold. I think gold can go to 2,500. I think we will see all-time highs, and I think there's a great backdrop for gold with geopolitical tensions. The U.S. dollar is starting to pull back. You have a lot of the volatility trade is flowing into that as they want less exposure to bonds. But also bonds in a way are doing well because, the Fed pivot is somewhat returning, but it's more in the middle ground. Not 6 cuts, not 0 cuts, maybe 2 cuts. And I think that's the sweet spot for bonds and gold to continue this near-term run.
All right, we ran out of time. You got oil down here. Oil's been acting really odd lately. It's come down a lot. Hey, Adam, great seeing you, my friend. Let's talk again real soon.
Thank you.